Americans are simply fucked. Americans are just in way too much debt. And we've just hit another record level. And I want to break it down and go over just how horrible this is for the average American. This is your week in money. The thing is, as of this month, November 2024, American consumer debt has reached unprecedented levels at this point, reflecting significant trends in borrowing and financial behavior. I'm going to give you 10 notable statistics illustrating the current state of this absolute insanity in the United States. To start off, total household debt in the United States has now surpassed $17.9 trillion dollars. In just the third quarter of this year, U.S. household debt increased by $147 billion, reaching a now total $17.9 trillion. And this marks a 0.8% rise from the previous quarter and continues the upward trend observed over the recent years. And this increase includes various debt categories like mortgages, auto loans, credit cards, and pretty much any other debt that you can possibly get. And credit cards are a big one. They fuel America's addiction to go in and spending money when we don't have it. Right now, as of the third quarter in this year, United States credit card debt reached a record high of $1.17 trillion. And this reflects a $24 billion increase from the previous quarter. This surge is showing significant trends in consumer spending and borrowing behavior. I think a lot of it is behavior, of course, as we've seen on my other show, but what did the experts say? A lot of people are saying that persistent inflation has elevated the cost of the goods and services that people are relying on, and this leads consumers to rely more heavily on credit cards to manage daily expenses. And corresponding elevated interest rates have increased borrowing costs, making it more challenging for consumers to pay down existing credit card balances. Plus, the post-pandemic economic recovery spurred increased consumer spending. People were locked down. They're like, I don't want to be locked down anymore. Let me go spend all my money. This contributed to higher credit card usage and, of course, consequently, greater debt accumulation. Now, one piece of good news in here, and there's not much because actually you'll see in a bit that delinquencies in general are going up. But despite the rise in credit card debt in the United States, there has been slight improvement in delinquency rates, but for credit cards only. Right now, approximately 8.8% of credit card debt transitioned into delinquency in the third quarter of this year, but this is down from over 9% in the second quarter. This is the first decline in delinquency rates in roughly 3 years. Maybe this is showing that easing inflation may be aiding consumers in managing their debt more effectively. But even with that rate going down, now the average credit card balance per borrower has increased to nearly $6,400 in the third quarter. And that's up approximately $300 from the previous quarter. And this rise is showing that consumers are carrying higher balances month to month, which can lead to increased interest payments and more financial strain. And with this, the utilization rates have also gone up, with the average utilization rate reaching 29% as of 2023, an increase of 1% from the previous year and 3.5% from the year prior to that. And of course, we know once you get to about that 30% threshold, this starts fucking your credit score. And this reflects an even greater reliance on credit for everyday expenses. And this increase in credit card debt poses many challenges for consumers and everyone else out there. The fact is, the higher debt levels lead to increased monthly payments overall and interest charges, which strains household budgets. And of course, elevated credit utilization rates, they hurt credit scores, and this can impact future borrowing opportunities, leading to even higher interest rates for other debts you take on. And now, if there are downturns, consumers with these high credit card balances may be more susceptible to economic downturns or unexpected financial emergencies, because most people, of course, don't have an emergency fund. As I said, credit card delinquencies, they went down, but delinquencies across the board have gone up. The overall delinquency rate went up slightly to 3.5% in Q3 of this year, which is up from that 3.2% in the previous quarter. This is, of course, showing a slight increase in the proportion of debt that is past due. A lot of this has to do with auto loans and mortgages. Auto loans rising by 0.2% and mortgages rising by 0.3 percentage points. The thing is, auto loan balances saw an $18 billion increase, which brought the total to $1.64 trillion in the United States. And again, the delinquency rates went up. And for the mortgage side, balances increased by $75 billion to $12.59 trillion. So again, those delinquencies went up by 0.3 percentage points. Does this increase in total household debt to $17.94 trillion reflect both consumer confidence and the economic environment? Maybe. Who the f Who knows? People make bad decisions all the time. And while higher debt levels can indicate robust consumer spending, which is important in this economy, and investments, the accompanying rise in delinquency rates is very worrying. On the good side, though, there was also improvement to the debt-to-income ratio across the United States, and this suggests that many households are actually currently better positioned to manage their debt obligations overall. Now again, I want to dive deeper into the car side of things because Americans are addicted to them. As of the third quarter of this year, the United States auto loan balances actually reached $1.64 trillion. This is an $18 billion increase from the previous quarter. People, this is just showing the constant demand for vehicles despite economic challenges and interest rates today. But what do economic experts say? They suggest that consumers continue to purchase vehicles, of course, and this is leading to higher borrowing to finance these acquisitions overall. And elevated vehicle prices have resulted in larger loan amounts for the buyers. Plus, higher interest rates have increased borrowing costs overall, which is even further contributing to larger outstanding balances. This shows that a growing number of the borrowers are facing challenges across the board in meeting their payment obligations for car loans with the delinquency rates going up. So I know a lot of you have been sharing how bad credit is holding you back from reaching your financial goals. I'm talking about struggling to get a good loan for a house or car, not qualifying for the best credit cards, or even having trouble renting. But I recently found something that can help you build credit without piling up more debt. Let me introduce you to the sponsor of today's video, my friends over at Kickoff. Kickoff is the #1 credit building app on the App Store and helps you grow your credit fast without the temptation of overspending. Starting at just $5 a month, Kickoff reports your on-time payments to all 3 credit bureaus. With AutoPay, you can build credit on autopilot. I'm talking especially to those with credit under 600 because the average Kickoff user jumps 28 points in their first month. You make on-time payments, credit bureaus see good behavior, and your credit grows. Got rent you already pay monthly anyways? You can even report that to build credit with a premium plan. Plus, you'll get free credit monitoring fast, easy disputes right from the app to stay on top of everything. The Kickoff app is super easy to use. Check out the over 100,000 positive reviews on the App Store. 98% of them are 5 stars, so trust me, you're in good hands. And it doesn't end there. Kickoff requires no credit check, has no hidden fees, and no interest. And don't worry about the endless customer service calls. They let you cancel any time. And the best part, if you're listening to this show right now, you can try your first month of Kickoff Basic for free. Head to getkickoff.com/YWIM to claim your free month and start building credit today. Your future self deserves that decision, and it's literally never been easier. Thanks to Kickoff for sponsoring today's video. Now let's jump back into the episode. Plus, then there's the subprime segment, which represents borrowers with lower credit scores and that has experienced higher delinquency rates. For example, in September 2024, the 60-plus day delinquency rate for subprime auto loans remained at 6.14%, which is insane, but it is consistent with the previous year, showing, maybe the stability suggests that while delinquencies are elevated, they've not worsened, I guess, even though 6.1% is pretty horrible. Now, outside of the subprime range, when we're thinking about everyone, for what it's worth, even though car prices and monthly payments have only ever gone up at this point over these past few years, right now the average monthly payment for a new car has actually stabilized at $745 a month in Q3 2024. But of course, this follows a crazy period of significant increases. Maybe the stabilization indicates that consumers are adjusting to higher costs and interest rates, but higher auto loan balances and increased delinquency rates may lead to financial strain for consumers overall, particularly those with the subprime credit. And delinquencies can negatively affect credit scores, making future borrowing more difficult and expensive. And a lot of these statistics all coming together can serve as indicators of broader economic health and consumer confidence. And as always, Americans are confident that they can afford their car payment even if they can't. You gotta be careful when accessing the affordability before taking on new auto loans. Gotta shop around for the best interest rates and loan terms. You don't have to get it with the dealer. Maintain those timely payments to avoid delinquency and protect credit scores. Understand these trends. Take proactive steps. You can better manage your auto loan obligations and maintain financial stability. I like the money guy thing here. Put 20% down. Make the term no longer than 3 years. Make sure it is no more than 8% of your gross income. Now, we mentioned homes. As of the third quarter of 2024, home equity lines of credits, or HELOCs, those balances in the United States have increased for the 10th consecutive quarter, now reaching $387 billion. This trend reflects a probably growing reliance on HELOCs among homeowners, potentially influenced by various economic factors. Again, what do the experts say here? They say that homeowners are capitalizing on increased property values, and to access those funds, they're taking out HELOCs, leveraging their accumulated equity. And with mortgage rates remaining elevated, homeowners are opting for HELOCs over cash out refinancing to avoid refinancing their entire mortgage at higher rates. HELOCs offer a revolving line of credit, which can provide flexibility for expenses such as home renovations. Don't do that. Education. Don't do that. Or debt consolidation. Don't. Maybe sometimes, but change your behavior before you do it, or you're gonna end up in debt again. The thing is, between 2023 and the second quarter of 2024, approximately 1.8 million HELOCs were originated, with 57% of them by borrowers aged 50 and older. You want to head into retirement without a monthly payment for the roof over your head. So this indicates a significant utilization in HELOCs among the older homeowners. Is this for retirement planning or major expenses? We don't even know. And half of the HELOCs originated had credit limits below $100,000, with 28% under $50,000 and 29% between $50,000 and $100,000. This kind of suggests that many homeowners are using HELOCs for moderate financing needs rather than large-scale expenditures. As of a couple months ago, the average HELOC rate was 9.25%. And anticipated Federal Reserve interest rate cuts might lead to lower HELOC rates, and this could potentially increase their attractiveness to homeowners going forward. But please be cautious. HELOCs typically have variable rates, and this can lead to fluctuating monthly payments. And access to substantial credit lines may tempt homeowners to borrow more than necessary, potentially leading to financial strain, and you don't need that right now. Also, utilizing a HELOC reduces available equity in a home, which could affect future borrowing capacity or proceeds from a sale. The sustained increase in these HELOC balances really shows a strategic shift among homeowners seeking to leverage their home equity amid the current economic conditions. Now, while they offer flexible financing options, it is critical for you to assess your financial situation and consider a lot of risks that come with it before proceeding. What can you do here? Managing and paying off bad debt requires a strategic approach to minimize costs and achieve financial freedom. Here's a potential plan to just look at. First, assess your financial situation. Include all the balances, the interest rates or APR, and your minimum monthly payments for each debt. Then determine your monthly budget. Identify how much you can allocate towards debt repayment each month after covering essential expenses. From there, choose a debt repayment strategy. Here are two popular and effective ones. There's the debt snowball, which you focus on paying off the smallest balance first while making the minimum payments on other cards. Once the smallest balance is paid off, redirect its payment amount to the next smallest balance. The pros here is it provides quick wins and psychological motivation, and it also encourages a consistent effort. But there's also the debt avalanche method. Here you prioritize paying off the card with the highest interest rate while making the minimum monthly payments on others. Once the highest interest rate debt is paid off, move on to the next highest. Pros here is it saves the most money and interest over time. This is efficient for minimizing total costs. Choose a strategy that aligns with your financial and motivational needs. Next, once you've addressed your behavior and your budgeting properly, consider negotiating and reducing interest rates. Call your credit card issuer. Request a lower interest rate, especially if you've been a long-time customer with a good payment history. And then there's also balance transfers, which again is only after you change your behavior. But you can consider a 0% APR balance transfer credit card for high interest balances. Pay off the transferred balance during the promotional period and avoid that interest. There's also personal loans, which is not as attractive, but you can take them out and they might have lower interest rates, and you can consolidate multiple high interest debts like credit cards. Then there's debt management programs, or DMPs. You can work with a credit counseling agency to negotiate reduced interest rates and combine payments into one monthly amount. But be very cautious, there are lots of baked in fees that might make it just as expensive or even more, so pick the right service. Now, of course, whatever method you do, snowball or avalanche, pay more than the minimum. Allocate additional income, bonuses, tax refunds, side hustles to the debts. You can also try bi-weekly payments. Split your monthly payments in half and pay every 2 weeks to reduce interest. And of course, through this entire process, avoid adding any new debt. You could freeze or limit credit card use. Use cash or a debit card for daily expenses until you've paid off existing balances. Now, through this process and in your budget, track your payments. Use a spreadsheet or financial app to monitor balances, payments, and remaining debt. One good way to do this is by taking our budgeting program, where you will learn all this in depth. And as you make progress, celebrate your milestones. Acknowledge your progress. Did you pay pay off a card, pay off a personal loan. Stay motivated. And once you're done with that bad debt, save at least a 6-month emergency fund, and it'll help you avoid going into this debt again if you got there because of an emergency. And by combining strategies and maintaining discipline, you can successfully pay off your debt, build a fully funded emergency fund, start contributing to retirement so you have a chance to survive. There are a lot of good things out in life, and even though this is doom and gloom in terms of where the average American is at, that doesn't have to be you. Get disciplined, and I'll see you in the next episode.